Good afternoon, everyone. Welcome to another one of our Wednesday webinars, our last Wednesday webinar for the year of 2018. Hope you guys had a nice Merry Christmas and are looking forward to enjoying an easy week here, hopefully in the stock market, but hopefully an easy week for you in life with some vacation time and some more holidays coming up with New Year's Eve and New Year's Day. I'm expecting a light turnout today, so we probably have a little bit more time to go back and forth and talk about charts and what we're thinking and maybe have some ideas about what's going on with the stock market. But we're going to do the usual. We're going to look at the S&P 500, the NASDAQ 2000, the NASDAQ Composite, the Russell 2000, and the Dow Jones Composite. And once we finish that, we'll look at the U.S. dollar, we'll look at gold and silver and oil, and then we'll move on to the chart requests. And like I said, we probably have a little bit more time to have some more open-ended discussion on some charts and some ideas as to what to do next. It's been an ugly time since last Wednesday, and that was one of the themes that we discussed, right, was this idea that the market can continue to get uglier, and that I thought it was a good idea to get defensive. And hopefully you guys were able to get as defensive as possible. I know it's not always easy to go ahead and shift towards a defensive focus when it comes to your IRAs and your longer-term accounts, but hopefully with your swing trading accounts or with the whatever account you're more active with, you were able to at least position yourself in a way to not get hammered by this down move. I'm glad you did, Denise, and I'm glad you had a Merry Christmas. Good to have you here, and thank you for all the attendance. You, Ray, Ron, some of the regulars. Glad you guys are always here, and hope you guys get value out of what I'm going through and reviewing every Wednesday. Yes, I did have a great one too, Denise. Thank you. So, like I said, last week we had a pretty good discussion on the potential for further market downside. Now, we were hoping that we would stabilize and bounce, but I wanted to warn that when the market is in this sort of a scenario, there is always a bigger threat to the downside, right? And so we need to be protective, right? And we need to make sure that we aren't putting ourselves in danger and get into a lot of trouble. And, as I mentioned, one of the things that I was focusing on was pretty much staying away from trying to trade stocks to the long side. I didn't really have any good short opportunities either because we were so stretched out that it makes no sense to short at the bottom. Despite the fact that we can continue to go lower, the risk reward is really poor, right? So the only thing that really was working was gold, and that did continue to go up. And as we go through the different sectors we like to look through, we'll see that gold is doing well and that there's really still not that much trading opportunities as far as individual names are concerned. There are a couple of maybe currencies that are looking like they can have some decent trades. But other than that, we're still in a situation where it's probably better to sort of step off the gas pedal, enjoy the holidays, and sort of wait for the next market move, and then from there maybe we have an easier trade. If you take a look at the S&P 500, you can see that we have really just sort of cascaded to the downside, and we have a nice green candle today, and are hopefully at this point ready to put in a short-term bottom, and more likely than not, putting in a reactionary bounce that will probably be sold off, right? So what I'm looking at right now and what I'm anticipating as far as how we're going to start or close out the rest of this year and start next year is we get a bounce, hopefully a strong one, but from there I'm actually going to be looking at probably shorting that bounce rather than trying to catch a long play right now. Again, I don't see a lot of plays to the long side that are very appealing right now. There are very, very few names that are on the right side of their moving averages, or for that matter, even on the right side of any kind of real support structure. So despite the fact that I think we're ready to bounce, I have yet to really find very many good charts that are setting up and look like high probability long plays. So for the most part, I'm still not really too excited about playing to the long side, and I want to play to the short side, but I want to wait for a bounce into resistance, and then from there I think it could set up for a nice play. So looking at the S&P 500, I want to scale back for a second and take a look at the weekly chart. And you can see we've actually retraced a very good portion of that rally we had back at the start of 2016 through all of 2017, right? And this is basically for the most part the Trump rally, where we started to rally right after the elections. Now, I don't think, and I don't credit him for this, despite the fact that he takes credit for it, but that is basically what it is, was the rally that occurred right after the election. And we have given back probably more than half of it now, right? This is a pretty good retracement. I think that, and then one of the things we discussed last week was that this is basically, this entire area is one of these vacuums as far as volume is concerned, where there is the threat of us coming back and refilling the entire rally. Now, I don't think that's going to happen right now. I think we've given back quite a bit of it as we speak. However, as you can see on the long-term chart, we've got ourselves two major ranges, and we have fallen below one. And at this point, if we do rally, I expect us to rally back up to about 250 to 255, and from there, that becomes a really strong resistance point now, right? That was a really strong level of support, and that should be pretty critical resistance now. And at this point, typically when you see a stock like this, you expect this to continue to eventually reach down all the way down to this 211 area. That may not happen anytime soon. After all, this is a market index, and sometimes they move a bit slower than what a regular stock would. But that would be, from a technical analysis perspective, the next target, right? Would be we come up, we fail up here at new resistance that used to be support, and then we roll right back over and start probing even lower, and maybe retrace this entire move. That may or may not happen, but overall, this is certainly indicative right now of a market rolling over and of a market top. I hesitate to say it's a permanent top, but things are looking more and more like this is sort of the end of the road for this bull market, and not necessarily the beginning of a bear market. I mean, depending on your definition, some people would say we're already in a bear market. I hesitate to say that from the way I not from a technical definition from a dictionary, but in general, if you take a look, we're still in a pretty, if you look at the long-term move on the market, I think we're still in pretty good shape as far as the long term is concerned. But in the short term and the intermediate term, it's not pretty, right? And you can see we've definitely found a short-term or intermediate-term top in the market, possibly even a long-term top. And at this point, this is why we need to be defensive, is because there is still further potential to the downside, and that potential could be realized very quickly. While there is potential to the upside, it's going to be an uphill climb now to try to get back above this area and to really struggle to fight through all of this selling pressure. But to the downside, we have plenty of room to go down quickly. And that's why we need to be defensive. That's why we need to be careful. And that's why we need to be very picky about what names we're trading right now and what types of trades we are looking at taking. So if we scale back to the daily chart and get a closer look at what we've done basically this year. So it's become increasingly evident that we will ultimately fail at this benchmark that I pointed out and that we've been following all year, which is the opening range, right? So we're going to close down on the year for the S&P 500, barring some sort of miraculous 3-day rally, right? Because what do we got? We've got the 27th, the 28th, and the not even sure. I think the 31st is a half day, right? So we've got about 2.5 more days, maybe 3 days of price action to get all the way back up to 268, which is pretty much not going to happen. So at this point, it's pretty clear that this is going to be a down year for the stock market. And now it's just a question of exactly what kind of red number are we looking at here, right? Are we going to close at the lows here and really start off the new year trying to push even lower? Or are we going to at least try to come back up and close the year close to, I mean, it's not going to be even close to break even anymore, but at least towards the year's range, and then from there we see what happens, right? So, again, I suspect that we get a reactionary bounce, and I think that we can make our way all the way back up to 255, which is actually a pretty decent bounce right now. That may or may not happen, but that is the possibility. The other possibility is that we just sort of flag here and have a pretty weak bounce, and just sort of chop around here, and then from there eventually roll right back over and start going down. I think in either case, the play I'm looking for is to short the next move down. So whether we bounce all the way up to 255 or whether we just sort of chop around in this area, either way, I'm looking for a short play to materialize out of either one of those scenarios. I am not looking for a long play right now. Now, we could end up chopping around and then break out to the long side, and if that occurs, at that point, hopefully I would have adjusted enough to look for long plays, depending on how long we take chopping around. But at the moment, really, my focus is to play a short based off of either a play back up to 255 or off of a consolidation and then a continued move to the downside. If we roll right back over to close today and start tomorrow, then I'm just going to keep standing back and sitting on my hands. It's the holidays, spending time with the family, enjoying the, at least in Florida, the nice weather. That's probably more important right now than trying to force any kind of issue out of the stock market. The stock market is not in a giving mood right now, and it's important to recognize that, right? We go back again to the weekly chart, and we've discussed this, I think, for the last few weeks. There are times when the stock market is a giving mood, and there are times when the stock market is not, right? So if we scale back and take a look at the last 5-6 years now, you can see the stock market was very generous from 2013 to about 2015. Anyone that traded to the long side was probably rewarded. In 2015, 2016, and most of 2017, most of 2016 and 15, actually a good portion of only basically 2016 and 2015. It was not a good stock market, right? It was actually a very punishing market, and a lot of traders got hit very hard and struggled to break even or struggled to not lose their accounts during that time. And then that changed again in 2017, and the market again was in a very giving mood through all of 2017 and a good portion of this year even. The market was kind of nice. But as you can see, we started the year poorly, and then we're finishing poorly, and it's turned into a market that is really not being that nice and is really punishing traders that maybe got lax with the easy conditions that we had in 2017 and the easy conditions that we had in 2013 and 2014. And this is the critical reason why these Wednesday webinars, why we always go over the market, is we want to understand what kind of environment we're in. It makes trading so much easier if you understand what the market's trying to do, what the overall current is, right? Because every equity we trade is just a little fish swimming in this massive current that is the stock market. And at the moment, the waters are not pretty, right? And the current is definitely going against us, and we need to recognize that, and we need to understand what plays work and what plays don't work. And at the moment, like I said, not a lot is working, so it's better to sit on your hands and wait. I know a lot of traders, a lot of professional traders, that have had a really poor last couple of months. And to be honest, I've actually done fine these last couple of months. And the reason for that is that I've been trading very, very scarcely. And the trades that I have been taking have not really been that correlated to the stock market. Again, if you guys, I didn't put up the link today, but let's see if we can put it up real quick. All right, so I typically put this up before it starts. Again, you guys know I'm stockdarts, and you know Frank is stock at 22. But if you follow me here at patreon.com/stockdarts, you visit that every day or every few days. You'll see that I post trade ideas, right? And I post charts, and I put trend lines, and I tell you when I'm looking to get into play, what names I'm adding to my watch list, what styles of trades I'm taking, and for the most part, those trades have done fine. The ones that have actually triggered have worked, and the ones that didn't work never really triggered an entry. And if you pay attention to that, you'll see that for the most part, we've been pretty cautious towards the end of the year. More than anything, just watching names and trying to find plays that work. But if they don't work, we go ahead and we don't enter. And then, as I said, one of the things that did work is that we sort of focused on gold and some other things. Here, Carmen, it's if you just go to patreon.com/stockdarts, right? That would be it. As you can see, I don't make a lot of. This isn't really about money. This is about giving you guys extra content. Um, and there are tiers here of different subscriptions if people are looking for options or for some other things. But you can see some of the headlines, right? Sitting on my hands, not really looking for trades. Time to play defense. Um, Looking for a play that could have worked as a short or a long and ended up working out very well as a short play. Trading gold. We've been very defensive and we've been looking at different ideas, but most of these ideas have worked, right? The gold play worked out very well. The short trade worked out really well. Some of these defensive names did not work out very well so far, but they never triggered. And then, of course, I was talking about how we want to be careful and patient. And so for the most part, the focus for me has been on just sort of playing defense and on sort of just waiting and riding out this bad market, right? And I think that's what we need to do right now is just continue to ride this out and continue to wait for better times. Just in case, I'll type it out for you too over here, Carmen. And so what I'm looking for right now, again, is for the perfect scenario. And the perfect scenario right now for me would be a rally up to here, which point short plays should set up. And that's probably the only scenario that I'm really looking at is those two potential short scenarios. And other than that, I'll just continue to wait. If longs are going to materialize, then they should set up. Now, the one thing I will say about long plays right now is if you are looking for some value plays, and Frank and I discussed this last week with oil, if you're looking for value names that you want to add long term, this is actually a good time to make a list. Now, I do think that there is a lot more potential downside in the markets. However, there is always the possibility that we find a floor here and build out a base and start making our way back towards the range that we spent most of 2018 in. And there are a lot of names like Apple, Amazon, which are really extended to the downside and are giving us prices that maybe we haven't seen in more than a year, year and a half, 2 years of action. And they could end up being really good value buys that a year, 2 years from now, you look back and go, well, why didn't I buy that level, right? So if you're looking for long action, you might want to look at some value plays that you think you can start to nibble at, right? I don't think that you should get too aggressive because I think that there's still more downside here. But I think that we're at a point where you should at least recognize that there is value on certain names. And these are the times when you should start slowly building positions, right? You don't want to add, let's say you haven't had Apple in years, right? And you want to own some Apple, then figure out a target number, how many shares you'd like to own, and then maybe just buy a quarter of that right now. Just to get started. And then if we continue to drop in the markets, then you'll be able to add comfortably without really worrying about where the price action is right now. And that would be one scenario where you could play for the long side. But that's really the only time, that's the only thing that I'm looking at right now, other than very quick reactionary bounce to the long side, which again, I'm not really excited about. I'd rather wait for the bounce and then play the short side. And you might ask yourself, well, if you think the market's going to bounce here, then why aren't you looking for long plays? And the reason for that is because, again, I think that while I think that we might bounce, I think there's enough selling pressure here that this could turn on a dime. Any sort of poor news event, and this could turn on a dime and head right back south again. And so I don't want to get too cute and try to play, try to time a bounce. I suspect that a bounce is coming, but more than anything, I think that there's a much higher probability setup after that bounce to the downside, which is what I'm concerned with and what I'm looking for more than anything right now. Okay, so again, we didn't really go over levels on the S&P 500. There are not that many levels to look at. Basically, 255 is critical resistance. Just above it is even more resistance. There's going to be a massive fight from 255 to 268. I don't think we really go through that level. But that's going to be a massive fight for the bulls to get through, and I don't think we do. Anything in that area is a very strong potential for rollover. And then, honestly, in the short term, we've got critical lows at 233. If we lose that, then I think we continue to swoop downward very fast. And really, the resistance to the upside has not sort of developed yet. other than up at 255. And it's just a matter of seeing how the price action takes form here. Like I said, whether it's a bear flag or whether we actually get a quick V bounce back up to 255. Now, we look at the NASDAQ, and it's a very similar picture in that we are sort of bouncing up into resistance as well, right? You can see we had this channel we're dropping from. Here's the break-even spot on the Qs, up at 162, and again, not that great, and doesn't look like we're going to get there either, right? So another index that definitely looks like break-even is not going to happen. So probably close it down here on the Qs as well, and it's the same idea. If we bounce up to this level here around the bottom of that channel, that looks like a potential short play. Now, we could get a flag here, and if that bear flag materializes to the downside, or materializes and then we get a resolution to the downside, then that's a good short. And if for whatever reason we linger around this level long enough and then start to build to the upside, then maybe that develops into a long play. But even then, it's not a long play I'm not excited about, because it's going to be just a bounce back up into resistance. So more than anything, just like the S&P 500, I think I'm more concerned with how we can play this to the downside, and what we can look at as far as how this behaves at the new resistance levels, and where it can go. If we take a look again at the weekly chart, and you can see that we are actually below the lows that we printed at the start of the year, right? So not as ugly as the S&P 500, but we are below a pretty critical support zone, right? So we're under the base, and the next or previous base was way back here. So again, that's a pretty big vacuum. That's a lot of price action that can be retraced without any real substantial support zones. We have a little bit of price action here around the 137 to 140 range, and other than that, it's almost a quick move right back down to 118 to 115. So overall, it's the same story as last week, where there's a decent chance we bounce, but I think that there is enough potential downside that, again, we need to be more concerned with protecting ourselves than with trying to profit and trying to get too overly excited about trading in this environment and in this sort of scenario. So more than anything, again, we want to play defense. We want to protect our capital for better times, and that means waiting for good trades and waiting for high probability trades. Years ago, when I used to blog on Frank's site on Stock Guy 22, I put up a series of blog posts on different ways to trade and my style. And one of the things that I compared it to, I don't know how many of you guys are poker players, but I'm sure most people are familiar with poker. But the stock game, to a certain extent, or the stock market is, if you're a swing trader, it's a little bit like playing poker. And there's a lot of parallels between them, but one big difference is that in poker you're forced to play every so many hands, right? The ante eventually gets to you, and you have to play whatever cards you get for that, right? But it's different in the stock market. You don't actually have to play. You can sit there and wait. You can wait until you get pocket aces, and you don't actually have to play any hand, right? So if you don't like the stock market, you don't actually have to do it. You could just sit there and wait. You don't have to be forced into a trade. You could just sort of wait and wait and wait until you get the perfect hand. And that's what we should be doing right now, right? We don't need to play this 5 and 10 that the market's giving us. We can just sort of relax and wait for pocket aces or wait for the best hand possible. Give me 1 second, guys. All right, sorry about that. So we are. Well, yeah. So I lost my train of thought for a second there. So back to the poker analogy, right? So Right now, the market's given us, these are two random cards, like a 5 and a 10, right, or a 7 and a 6, or not even a 7 and a 6. So that's too good. Um, and we don't need to play that hand, right? We could just throw it back and we could wait for a better hand, right? And that's what we should be doing, is we should just be waiting for the perfect hand. When the market's in a good scenario, right? When the market's like it was in 2017, um, that's different. Everything works, right? So we could play all the cards that it's giving us because you're in good shape, and for whatever reason, the cards are coming your way, and things are working, right? But that's not the scenario now. We're definitely fighting an uphill battle, so we need to pick our spots better and wait for better plays, right? And that's what we've been doing, or I've been doing, and that's what we need to continue doing. And so that's where we stand, right? So with the Qs, there is, again, if we lose the lows from the last couple of days, then I think there's significant downside, and we could continue to really sort of crash. And if we do bounce, I'm looking for a bounce up to about 154, 155. Even if it gets a little bit past that, anything in that area, once I start to see a rollover and some candles failing at resistance, I think that makes for a good short and a good way to maybe start next year. Now, again, a lot of times the market changes character uh, at the start of a new year. We're humans, and this, again, when you look at a chart, you're looking at a picture of human behavior. You're not really looking at an equity um, from a financial sense. You're looking at what traders think about that equity, right? So sometimes you turn a new page, start of a new year, and the behavior changes pretty quickly. So we'll see what happens as we start the new year. But my anticipation right now is that we're going to come up into resistance, and from there still be some good shorts to look at and play to the downside. Now, if we move over to the Dow Jones, I think the Dow Jones is basically a mirror image of the S&P 500 right now. We're well below the year's range on this one as well. You can see a pretty clear rectangle, right? And we failed, and we're basically again retracing a big portion of the move we had from the previous year. And at this point, a rally to the back to the bottom of the previous base, it should be resistance. It should be a point where a good textbook short should materialize, and we could play it back to the downside. I think again, it's pretty obvious what's happening here, and a lot of traders are probably having trouble seeing it because they subconsciously don't want to see any more selling pressure on the market, right? But that's what we're getting, and we need to react to that, and we need to find the plays that work best in this environment. So again, I think that's the easiest play to really watch for, and for us to sort of pay attention to, a way to set up. Same as the S&P 500, there's the break-even point for the year is so far away that we could basically assume that it's going to be a negative year. If we lose the lows from today, then there's a lot of more potential downside, and it means we continue to crash. That would be pretty ugly considering the rally we've had so far today. Again, let's go to a 5-minute chart, and you can see we've had a really good bottom, and we've had a nice day so far. And hopefully we can close strong. But if we close weak and we close right back at the lows, that's really ugly because that's a big amount of price to give back, right? Typically in these holidays, we get light volume action, which is usually pretty benign. But that's not what happened on Monday. So we have to sort of be careful and wait for the price action to finish before we could really make our judgments. But it looks like we're going to finish strong today. And again, I think it's the beginning of a nice bounce to close out the year. But it's a bounce that to me is too little too late, right? I think that at this point, there's been so much selling pressure that at this point, this bounce is just shorts taking profit, and it's just names being closed out or being bought into the end of the year. And we'll see what happens once we start to approach these real levels of resistance, and how the market behaves from there. And then finally, we have the small caps. And again, the small caps are struggling. We have a nice day today, but look at how far we have to go to break even for the year, which is not going to happen. And look how far we have to go just to our previous level of resistance. We're a good 16 points away from just coming up to test resistance. There's a pretty good chance that if the markets do bounce and then roll right back over, IWM will never even reach 145. There's a pretty good chance that IWM just hits about 135, 136, and from there hits too much resistance already. Maybe it bumps into the 20 period of the 50, and then from there we see what happens. I think overall the markets again are ugly. For those of you that are regulars, those of you that have followed me throughout the years, um, there have been points in the last 5, 6 years where traders thought that we might be at a market top, and my thought process always for that was, don't worry about it. We don't have enough warning signals for us to be at a market top. I think that the market's still healthy, and I think that we can continue going higher, and whatever, blah blah blah. Um, that is different this time. We have enough warning signals here where I can't just tell you, yeah, we're going to continue to go higher. I think since October we've had warning signals. Those of you that again are regulars know that back at the end of September, right before October started, I warned you that there was a decent chance we were going to correct. Now, did I expect us to swoop through the year and close down here well below the base? No, I'm not going to say that I did, but I knew that there were warning signals telling us that the market was shifting in character. And as it's continued to get worse, I've continued to revise my outlook and warn that things are uglier than maybe what you would think. And I think at this point we're still in a situation where, as ugly as it's been, there is potential for uglier price action. So that's why I continue to harp on this idea of being defensive. Again, I don't want to be like this fear monger and try to scare traders and just say it's all doom and gloom. I think that there's still a decent chance that we spend the next couple of years trading sideways, not necessarily crashing. But I think that there's enough warning signals here where we need to take the possible scenario of an actual market crash much more seriously than we have. And some would say we've already started to crash, and I wouldn't necessarily argue with that. But I think that there's still potential for a much more catastrophic drop than this. And it's just, the headlines aren't there, but the price action is. And I think it's one of these, situations where we need to really play defense. Like I said again, you want to emerge from this once the price action shapes up. You want to emerge with it with the kind of capital to buy names that are at all-time lows or in very good value spots. And you can't do that if you lose all your money trying to catch bounces and trying to trade through this market chop. This is not a good environment for anyone other than day traders. And if you're not a day trader, then you should really, really be a lot more careful about what you're trading and a lot more cautious about how you behave in this market. If you're an options trader, you can sell volatility, and that's working out pretty well. But other than that, you really need to just sort of be patient and wait for better opportunities. All right, so that's the four major markets. Not a lot of positives today, and really not looking for positives anytime soon. I think, like I said, even if we see a bounce, I'm expecting it to be a bounce that resolves and sets up negative plays more than anything. So overall, not really in a good place. Now, let's take a look real quick at the US dollar. We're going to look at gold and silver, and then we'll move on to the chart requests if anybody has any. If you look at UUP, we actually finally sort of fell below this trend line, right? So the US dollar is starting to lose a little bit of strength. I think it's still very strong, but we are starting to see some pressure on it, which is actually good, right? At this point, we want to see the US dollar lose some of its strength to sort of ease off the pressure on the stock market in general, but even on some commodities that are finally starting to pick up some strength, right? So if we look at the individual crosses, here's what the euro US dollar looks like, and actually pretty ugly. Last week I actually advocated going long on the euro, and that did not work out. Typically, when you have a triangle like this and you have a false breakdown and it resolves to the upside, that's almost always a clear-cut, easy winning trade. And with the US dollar losing traction, I'm actually very shocked that the euro is rolling over. So at this point, I would say that we need to wait for more resolution here. I still think that the long play hopefully works out, but this is definitely, that was a failed trade and that did not work out. And at this point, it's kind of baffling to me that the euro is dropping at the same time that the US dollar is losing traction, right? So, there's more than anything maybe some yen strength coming in here, at least as far as the crosses we like to look at. Now, I do want to point out the U.S. versus the yen. The yen did pick up a lot of strength, so this is one of the components why the UUP index started to drop. Is this? But typically, the U.S. dollar euro combination is the one that really affects the UUP index the most. And right now, what we're seeing is weakness here against the yen. The U.S. dollar has not really come down yet versus the Canadian, but I expect this to come down now. I think it got a little too ahead of itself, and with oil finally maybe bouncing, we can see this one sort of come back into this channel at the very least. But interestingly enough, as you can see, the three currency crosses we look at don't necessarily mirror what we're seeing on the UUP index, right? So I think that there's still some sort of murky action here going on with the U.S. dollar. One thing I will point out is GLD. GLD continues to do very well. It's fading today, but I think the overall price action and the trajectory of price has been good. The miners have done well, but not as well as GLD. I think a good reason for this is that the stock market in general has done so poorly that the miners are still getting caught up in this mess. They're still doing okay. They're above their 50 and 20 pair moving average, which is something a lot of stocks can't say. And I think overall are still positive, but they're not doing nearly as strong as GLD. SLV finally cut a bid and got outside of this big base. So overall, it's finally starting to follow GLD and break out. However, I still think as far as precious metals are concerned, we want to be looking at GLD more than SLV. We want to look at gold names, gold miners, more than silver names. And overall, I still think that the gold trade and the gold names are still a good place to trade right now, because when the market stabilizes and bounces, those names should get a little bit of easier sort of, get some wind behind their sails and have some easier moves to the upside, as long as GLD can continue to sort of make its way upwards versus the US dollar. Now, the last commodity we want to look at is oil, and this will be a good segue into Denise's question about OIH. Here's crude oil futures. You see, we have a very strong day today, and we finally hit a major support level on oil, which is way down here around $42 a barrel, right? I can actually extend this base now a little bit. And so, I mean, we've come full circle, right? We've come all the way back down to this base that we spent quite a few years in, right? And oil should bounce from here. But again, oil probably should have bounced up here 55, and it didn't. But I think that this is a good level of support, and one that oil prices probably don't want to drop $40 a barrel. So I think that there is definitely potential for some oil names here. We actually discussed oil names in general last week, Denise, but I'll go over some of the basics. Here's OIH. OIH is looking ugly. My thought process was that we wanted to wait last week on oil, right? And I think that I personally would still be waiting for a more substantial bottom than what we're seeing. We have one green candle. I don't know that we haven't based out yet and formed a substantial bottom, but I think oil is reaching a point where it's just at such strong value or such strong support that we could probably look at some value names. That was what Frank was advocating last week, was looking at some names like ConocoPhillips, right? And I'm going to just go, instead of going to the daily charts on these, we're going to look at the weekly. Right, and we can see, actually, COP lost that level we were looking at last week. So that's one of the reasons I thought that maybe we want to wait a little bit longer. Was when a stock reaches value, that's good, but you still want to see some support confirmed. And so far that hasn't happened. But you can see where we stand on this and what the major levels are. Exxon was another one, and Exxon also lost a major value and is trying to form a bottom here. What was another one? It was Exxon, it was ConocoPhillips, and Suncor was one. It's the Canadian company. Also losing some key levels. Just in general, I think that they're all losing those levels that we were looking at. So despite the fact that CL is doing good, I think that we need to see some positive action on these names before we are ready for them. You mentioned a couple other ones. We've got Phillips 66. Oh. A little bit better. I mean, it lost a pretty critical base, the top of that base, and right back in the middle. Um, and Chevron. I think. Oh man, yeah, this is. So I mean, Chevron's still at support, right? So I mean, out of the ones we just looked at, as far as the value levels, this one looks like it's the relatively speaking the safest one. Um, but I think overall right now there is, these names they still need work to do. Again, I think Frank and I are in a different spot here. Uh, and he's not with us today. Obviously, he's enjoying the holidays with his family. But he's usually more aggressive about buying these value levels than I am. I like to wait for a chart pattern to develop at these levels before I go ahead and get long. So I think some of it depends on your aggression level. I think, again, because of what we're seeing in the overall markets, that it's more critical to play defense right now than to try to get overly aggressive and try to play too many of these value names. That being said, sometimes these commodities play a little bit different. There are also, I went over these last week as well. There's a lot more drillers and oil names that we can look at, right? So we can look at stuff like this. And again, you can see it's just this area has been just hammered, right? So here's Patterson. Kinder Morgan looks okay, and again, these are just different oil names that maybe not the big refiners, but drillers and whatnot. You can see again, some of them are in better places than others, but mostly this entire area has been really hammered. And until we see more stable basis form, I think I'd rather just wait and just I want to see better price action before I get involved. But I will say that a lot of them are setting up plays around value levels, and it's just a matter of those value levels developing now. So there's something you can maybe put on a watch list, maybe build a watch list of a bunch of oil names and wait. But I'm not excited about this yet. I think that there's still more time before they set up. I'd much rather play gold names right now than play oil names. I think the gold names are already moving and have already gone through a lot of this process while these guys are still sort of trying to stabilize. I think that's the big thing. All right, now you have another question concerning longer-term stock trades. Other than covered calls, what else can one do to protect from the downside? All right, so take this now. I will say one thing, right? You probably have more experience as a long-term trader than I do. I did not really get involved in the stock. I mean, I've been involved in the stock market now for about 10 years, but I've almost been purely involved in the stock market as a shorter-term trader. I was a business owner for a while. I don't have like a big IRA with a bunch of names or anything like that. I basically just trade my own money. So I don't have a lot of long-term positions, but my expectation right now is if you have a lot of long-term trades and you're trying to protect yourself, what can you do other than covered calls? And I know you do, Denise. I know you have short and long term. You're a pretty active trader, but I know you have a long term. You do have some trades that you have long term focus on. It's something I really should be more involved in is doing more long term stuff. But I don't know. I get aggressive with my capital sometimes. But so other than covered calls and callers where you sell covered calls to buy puts, the only real other way to protect yourself right now is through asset allocation, right? You obviously, if you have a diverse enough portfolio, if you have certain names that you're not that comfortable with, you can move them to safer names, right? You can move to, and unfortunately, when a market is really ugly, there is no real safety. I mentioned part of getting defensive was looking at utilities and REITs, and they've been hit hard. Just the same. Now, have they been hit as hard as the market? No, but you look at what they've done recently, they're getting hammered too. But what you want to do in these scenarios is you want to move to safer assets. and that's kind of what we always see, right? Like, if you take a look at what IWM has done, right, compared to what, say, the S&P 500 has done. And I mean, they're both ugly, but IWM has typically been more relatively weak when the market drops, right? And that's because traders are doing that. They're moving from more risky assets to safer assets, right? And I think that that's really, if you want to make sure that you have skin in the game long term and you're always involved. And I think that there's a good point to that, right? If you're a long term trader, you don't want to just go straight to cash, because then that's means that you're assuming that you have perfect market timing and that you don't trade with mistakes, right? And that's not the case. A lot of times the market gets ugly and then bounces long before traders realize it. And if you're trying to get too cute with your long-term positions, you miss out on a big move, right? We go back, say, let's go to a monthly chart. And if a long-term trader, let's say they timed it perfectly and they decided to go to cash in the middle of 2007 and they missed that entire drop, they might not have gotten back into it until like 2012 or 13, and they would have missed out on a huge run, right? So, you want to be involved, and I think at this point it's a game of asset allocation. You want to find stuff that gives dividends. That way, if they do go sideways, you're manufacturing a return. And I think we discussed that last week, that a lot of what you want to do right now is manufacture your own return, and you do that by finding names that produce dividends that you can sell calls on. And I think that's the best way to sort of play defensive in this environment from a long-term perspective. You're going to get hit, and names that you believe in, you just have to weather the storm. And unfortunately, like you said, other than covered calls, selling puts on names that you're willing to add, there's not much you could do. You just have to sort of put up with it and maybe try to make up some of that with other plays, right? And that's what the swing trading is for, is to sort of play to the short side and take advantage or get some market hedges. That's another thing. When Frank was a lot more heavily invested in the market, right? The last year and a half, almost 2 years now, he's been day trading a lot, right? But if you were around 2015, 2016, he would hedge a lot, right? He'd put a lot of put plays on the market, and that way, even though he was losing money on his portfolio, he was at least sort of defraying some of that with put positions on IWM or the S&P 500, and that is another way to sort of protect yourself, is to play some market options plays to the downside, that if they don't work, you lose a little bit of capital, but not that much. But if they do work, then at least it makes up for what you're losing on a lot of your names, right? And that's another way of trying to protect yourself. But as far as the individual names, there's really not much you could do. It's more along the lines of how you set yourself up with the rest of your trading program, or your approach to the market, right? So that's another thing we advocate here, is being diverse, not just in the names that you trade, but in the styles that you trade. And that's how you weather storms like this. So these last couple of months have been rough for a lot of traders. They haven't been that bad for me because, again, I know how to. I play options. I like to trade options. I like to trade currencies. I like to trade cryptocurrencies. And there are ways to sort of not get too tied up or heavily invested in a directional market, when you can play non-directional strategies or find other less correlated equities, and that's probably the best approach, right? So play some hedges on the market, move to dividend names, and then try to weather the storm that way. I think that's the best thing to do. No problem. That was actually a very good question, and hopefully it was a question that helps out some of the others in here. That was actually that's kind of what we have to go through during these sorts of markets, right? Is try to find ways to survive, and if we can, then when the market gets better, then we're back in it, and we can make it up, right? And that's what happened. I mean, think about how many traders in 2007, 2008, how many IRAs, right? I don't want to say traders because a lot of traders go bankrupt. They can never get back in it. But how many people were just destroyed with their IRAs where they basically felt like, well, I can't retire. I'm never going to be able to retire. I'm going to have to work for the rest of my life because of how much money I lost in my retirement account. And then that all basically was neutralized just in a few years, right? And look where we are now. And that's sort of the thing that you have to understand with long term. We're going to, I mean, obviously not IWM, but let's take a look at the S&P 500. In the long term, whether it's inflation or just whatever, in general, the market always goes up, right? And so you have to be able to just weather these storms. And that's what I've been kind of telling my parents, because of course they're worried about the market and they're wondering why they're losing so much money in their IRAs. And all I can say is, like, you know what? You have to put up with this, right? We've just gotten 10 incredible years in the market and we're starting to see some selling, but we're nowhere near where we were 10 years ago. And I don't think we really shouldn't get anywhere near there. Even if we have another massive crash, we should still be ahead of where we were before. And usually this comes right back. And so you need to just have faith in the way this works, have faith in compound interest, have faith in the overall trend of the market, and let it do its thing. And just let it do its thing, right? Not get too excited or too overly cute with it. Now, again, that's with respect to long-term trades. Short-term trades, stop out, get out of it, right? You don't have, if you have, you can't absorb those kind of losses in long-term names. In short-term trades. If you're a swing trader, by the time we get a strong bounce, you might not be in the game anymore, right? A lot of traders went bankrupt in 2007, 2008, because they were just waiting, thinking, oh, it'll come back to me. Then before you know it, they get a margin call and they're done, right? So it's really more a matter of understanding what your overall objective is with each account or with what you're doing, and then making sure that you can survive for the better times. Okay. All right, that pretty much covers it for today. I want to thank you guys for attending. I want to thank you for participating. Most of you guys I want to thank for being around all year, right? I know this. I do this for you guys, but I still appreciate the participation. I appreciate the attendance. Makes me feel like at least I'm doing this for a good reason and I'm helping somebody out. So as we start the new year, if any of you guys have any advice or any kind of thoughts on something you want from me, some different topics we want to cover, feel free to message me, and I'll see if I do some of these based on different ideas. I'm always looking for positive feedback, whether it's on this or whether it's on the Patreon page. If you guys have different ideas or thoughts on ways to improve that as well, just let me know. I'm more than happy to try to help traders out. And I really want you guys to do well. I don't want it, this isn't just, it's not like I'm doing this to make money. You saw on Patreon, it's very small amounts that I ask for, and it's only really just to sort of make it even remotely worth my time. But I really want traders to do good, and I want you guys to sort of be able to survive these sorts of markets, to do well in the future. So if anyone has any positive feedback or any thoughts, just let me know, and I'll look to give you guys more content that helps you as traders. Other than that, the crypto is doing fine, Ray. It's been mostly like very similar to what we're doing in the market right now. Sitting on my hands, that I'm down on the year for sure. But I'm kind of waiting. I don't have any subscribers, right, that actually subscribe to the crypto. But like, I still trade cryptos on the side, and I have a group of friends that we share ideas with, and there is a bottom in sight, and I think that there is potential for them to pick up some steam into 2019. And of course, I actually have a free video. I believe on my Patreon, if you go all the way to the very beginning, if you scroll all the way to one of the first videos I ever did, it is it's a pretty good video explaining what cryptocurrencies are and how they work. Watch that, and then if you have questions, ask me. But I have if you, I mean, you have to scroll all the way to the very beginning. I'm not even sure where, but there was, yeah. Or if you search on here, I did one on cryptos, and I did a few, but I did one an educational one, and it's on there. It's on my YouTube page, and go through that. It'll tell you how cryptos are and how they work. Um, and yeah, they, you know what, the good thing about those guys, and you know, I know a lot of traders hate these things, right? But the thing with cryptocurrencies is that even when it's doing bad, you could still get like a 30% bounce in just a few days, right? I mean, just take a look at from 3,300 all the way up to 4,300, right? So you got a thousand bucks in 4 days, right? On something that was at 3,000. So you can get massive moves on those things. They have a lot of volatility, which is what you're looking for. That being said, I think that they obviously are in a pretty ugly bear market themselves and still have a lot of work to do. But overall, in the long run, they've still done decently, and I think that there's still potential in this area. And I think that there's still, whether they're used as currencies or not, I think that there's still a lot of cryptocurrencies that have a lot of utility as far as blockchain technology, as far as transforming the way the world works in the next 10 years or so. So I think that there's still a lot of potential for these things in the long term. Um, but yeah, so go ahead and check out that video, and if you have questions about it, feel free to ask me. But other than that, I hope you guys have a good rest of the rest of this year. We will maybe meet on January 2nd. I'm not sure about that yet. It's the day after the 1st. I'm not sure whether we should have a Wednesday webinar, but we might. And if we do, I'll tweet it out. And other than that, I hope you guys have a good rest of the holidays, and we will see each other again in 2019.